let's start off with that MPC decision yesterday, largely in line with consensus. We saw a hike of 25 basis points filter through, but certainly the central bank more aggressive than the markets had initially anticipated it would be.
I cannot hear.
Kato, can you hear me over on that end?
Yes, I can hear you.
Well, let's get straight into your view on the interest rates decision that came out of the MPC yesterday. Of course, that 25 basis points largely being anticipated by the market, but the CBN a little bit more aggressive than it had been anticipated it would be.
No, I think it was very good for the banking sector. We need rates to rise. These banks will respond positively to a higher rate environment because remember, these balance sheets are very liquid. So I think the rate decision was very positive. And also increasing the liquidity ratio is another positive indication. The central bank, in my opinion, would not have increased the liquidity ratio if it was not more confident in the solvency and liquidity position of the banking system. We had reduced the liquidity ratio during the crisis years in 2009. What we're doing is we're returning to previous levels. That's because the CBN, the banking system, is on a much better footing today than where it was in 2009. So I take the actions by the CBN extremely positively. I think we need a higher rate environment. We need more positive real rates in Nigeria. And we need a strong statement from the CBN saying that we are moving in the right direction. And you can only do that by increasing the liquidity ratio and your cash reserve ratios.
Of course, we've seen that liquidity ratio up to 30%, cash reserve requirements up to 2% as well. But having said that, I was speaking to a broker last week who used Fidelity Bank as an example, a case in point where the bank has got capital looking to be put to work. But as is the case with most of the banks still in Nigeria, it's not lending. So what evidence are you seeing of credit lines actually starting to loosen up on that end?
Credit lines will loosen up, but it's a gradual process. What you're seeing in Nigeria is a lot of the banks have tightened their target market list. What the banks are doing are focusing on AAA accounts and then mining the value chain. Now, if you go back to 2009, a lot of the banks actually stopped mining the value chain. All they did was lend to the AAA accounts. So you would lend to your MTNs, your Nestles, but you wouldn't lend to their distributors. What the banks are doing now is that they are going to their distributors. That revenue, that loan growth will come through. It will come through gradually, but it's definitely there. Don't forget, we are operating in an environment where you've got 20% nominal GDP growth. It's not a question of are there opportunities? There are opportunities. It's about pricing the opportunities correct. And the banks want to make sure they're pricing the opportunities correctly. So it's going to be a gradual process and it will come through. And the actions done by the CBN focus on liquidity. When you add to that the capital that these banks have, the healthy banks in the system, is more than sufficient to fund revenue growth in 2011.
Taking a look at the status as it stands from your perspective on that front then, I mean, what's your outlook for the banking sector as a whole moving forward, where we've now seen most of the hurdles being cleared and AMCON looking to settle things finally come March this year?
I mean, my outlook for the banking sector, to be honest with you, has never been more positive. We have a lot of good things happening, and in particular, we have the unwinding of the CBN. That is what AMCON really does for us. Remember, AMCON has effectively taken off the overhang in the Nigerian equity market. So you are seeing banks that continuously used to struggle, no longer struggle because the overhang is gone. AMCON also will allow for improved asset quality across the banking system. And then with the decisions taken by the CBN, we will see a higher rate environment, so we will see higher yields on bank assets. Lending yields remain very attractive, and also what we're seeing in the banks, because they have learned from the lessons of the past, is a great deal of focus on costs. So we're going to see stronger revenues and lower cost growth. So we're going to get positive jaws in the system. And the risk charges are going to be much lower. We're going back to historical levels. So when you put that together, you're looking at very, very strong P&L growth. 2011 should be a peak year for bank earnings. Amongst the healthy banks, that is.
The healthy banks, and that's an important distinction to make, because I want to take a look at your approach and if it differs when it comes to your approach towards the healthy banks and then towards those rescued players in the market.
Yes, clearly, from an equity investor perspective, I fail to see the value in buying the affected banks. That is because the CBN, as we know, will be at AMCON, not the CBN, I beg your pardon, AMCON, will be recapitalizing these banks to zero. Therefore, there is a significant amount of equity dilution that is coming to current shareholders. And then after that, whoever eventually does acquire these banks will recapitalize them to 10% of risk-weighted assets. So there'll be further equity dilution. So shareholders today will effectively own nothing of the new bank. So when you look at the banking system, my belief for equity investors is that you must buy the banks that pass the audit. The assets, that's not to say that the assets in the affected banks are not attractive. I think the assets are attractive, but they're attractive to buyers of those assets. Okay, so if the healthy banks participate in the M&A consolidation process, they will be buying some very attractive assets at very discounted prices. So that is an attractive transaction. But equity investors must, in my opinion, or should stay clear of the affected banks and begin to buy more of the healthy banks, particularly the larger ones.
So what stands out as a stock pick for you within that banking sector?
For me, it's the big three, and Zenith in particular. You know, if you look at the stocks that we cover, the 6 banks, they represent 44% of total system assets. But their equity is 3 times the size of the net equity in the banking system. So you have significant capital concentration in our universe, but you don't have asset concentration. Asset concentration will follow capital concentration. Big is best right now in Nigeria, particularly if you look at the operating efficiencies of the banks. There's no one clear differential factor in the banking system. It's still too immature. So what you need are big, liquid, healthy banks with strong balance sheets. And top of that list clearly comes across as being Zenith, with a very low NPL ratio, sub 6%, around 6.4%, and very strong capital levels at 27%. That is a very strong stock.
Well, on that note,